Hi everybody, Thomas here. Today we're going to be taking a look at one of the biggest streaming services in the entire world, and that is Netflix. And take a look at its business and its stock. We're going to try to evaluate whether or not this is a stock that represents our proverbial sucker's bet, or if there might be something else that investors might need to pay attention to right now. Let's dive in. Rather than a normal weekly chart, which I usually pay attention to, I've switched to a daily chart for Netflix. That's because as I'm paying attention to my charts and looking for the kinds of bullish level 1 and bullish level 2 patterns that I like to use for my Rebel income system, sometimes switching to different time periods can offer different insights, and signals can come up on any chart period, whether it's a daily, weekly, or otherwise. In this case, we're looking at not quite a bullish level 1 pattern, but something that is starting to look like it could give us a level 1 signal in the very near future. As always, we've got our different moving averages. The 200 period moving average, in this case a 200-day moving average, has been moving up very nicely, as we can see. And even now, as the stock has been following a long-term upward trend over the past year, it has retraced and come down a little bit over the past few months, and that's led to the 200-day moving average starting to flatten just a little bit over the last couple of weeks. The 20-period moving average has been coming down as the stock has been picking up a lot of bearish momentum lately. There's been a lot of pressure on entertainment companies, streaming services in particular, as the market has grappled with things like higher interest rates, the effect that that has on consumer spending, as well as the basic fundamentals of a lot of the companies that are involved in the various streaming wars that are going on right now. Netflix then has really dropped quite a bit from this peak at around $480. In July of this year, the stock has dropped down to this current level right around $373. So that's more than a $100 drop over the past few months, which is easily about a 20% decline over that period. That's deep enough to mark its own bear market level. And with the stock now hovering right around the 200-day moving average, the question starts to become, has it dropped enough to begin to stabilize and find a new point to rally from? Well, as we can see from the price action that we have going on right now, the stock was picking up quite a bit of momentum over the last couple of days. Today dropped pretty sharply and is hovering right around the 200-day moving average at around $373 per share. Let's take a look at the fundamentals for Netflix and see if those suggest that the latest decline in the stock's price might be enough to make the stock a good value right now, a good bargain, or if there may perhaps be some additional downside that we need to pay attention to. Over the past year, free cash flow has been increasing on a pretty significant basis. From about $717 million a year ago, we see that the number has increased to $4.26 billion as of the most recent quarter. That also marks a pretty significant decrease, a little bit below $3 billion in the quarter prior. So free cash flow is growing on an increasing basis over the last year. This also confirms a larger pattern where Netflix has emerged from a continuous multi-year pattern of no cash flow at all because of their heavy investments in developing their own content. Those have begun to bear fruit and have led to a very solid increase in these free cash flow numbers, as we can see. Given the stock's market cap, the free cash flow yield at about 2.5% is modest, but the really important takeaway is this increase to this current level at about $4.26 billion. We can also see that cash has been increasing over the same period. Again, on both a 12-month level, from about $6.1 billion to the current level at almost $8.6 billion. And also over the last quarter from $7.8 billion. So it's increased by about $800 million just in the last 3 months. That's also a significant improvement. Long-term debt sits at almost $14.5 billion. It's a little bit higher than cash, but considering the pattern of increasing cash flow as well as increasing cash, looks like debt service should not be a problem. That's also confirmed by the company's pattern of increasing profitability as measured by net income. We can see over the last 12 months that net income versus revenues was about 13.22%, but that also increased in the last quarter to about 18.17%. So all of these are very positive indicators that the company is on very solid financial footing and that financial footing is getting stronger. If you've been watching my videos for a little while, you already know that I like to pay attention to dividend-paying stocks. Netflix, like a lot of tech companies, does not pay a dividend at all. And that means that this is a company that normally would not fit into the profile that I look for my Rebel income trades. However, if dividends are not a primary criteria for you, the really interesting thing about all of this fundamental strength that we are looking at right now is that the stock's current price at $373 might sound kind of high, but the truth is my valuation analysis suggests that the stock's fair value target is well above $1,200 per share. So that means that we've got more than 227% of projected upside from the stock's current price. So that does make it look like a pretty interesting value right now. We already took a look at the stock's price chart and talked a little bit about its price action. But let's take another look at that and consider exactly where the stock is at right now in terms of how much technical upside. It's one thing to say that the stock's fair value target is above $1,200 per share, but what kind of technical situation are we looking at right now, and how practical may that be within even the next year or so? I already outlined some of the stock's current levels of resistance. We have the first most immediate level of resistance is right at the 20-day moving average right now, which is right around $385 per share. If the stock can break above that point, the next likely level of resistance is going to be right back at this previous pivot low that we saw in mid-August, which lines up right around $400 per share. These are relatively immediate levels of resistance. If the stock can continue to maintain and build on the momentum that started a couple of days ago from the 200-day moving average, then it's going to need to break above these levels in order to actually reverse the downward trend that we've seen develop since July of this year. We can see that pattern is moving just about like that. From there, if we do see the stock break above 400, it looks like we have some additional possible resistance here at about 415, and then from there, possibly, if we can get above that point, then momentum should really start to pick up, and we may see it start to hit about 440, and then of course we have the stock's July high at around 480. So all of these are a fairly long way away from the $1,200 price target that we were just talking about in terms of its valuation and the opportunity that may represent in the long term. These give you some good price targets to think about, though, assuming the stock begins to reverse this current downward trend. These are going to be the levels at which the stock is going to have to break above in order to maintain and continue to push through in forming a new upward trend. The next question then is, if the stock does break down, if it doesn't hold and actually reverse this intermediate term downward trend, how far could it drop? Well, we have current support right around the 200-day moving average, as I've already observed, which also lines up with some pivot lows all the way back at the beginning of this year, right around $373. If we see the stock break below that, if it drops below the 200-day moving average, I would expect to see next support back at this pivot high that occurred, it looks like, in March of this year, and is in the neighborhood of about 350. From there, we have a pretty good way to begin thinking about the stock's reward to risk. The reward in this case, we have the stock right around $373 right now, with near-term upside to about $385. That means there's about $12 of upside. With the stock very near current support, that means that if the stock can bounce off of current support at 373, there is about $1 of downside. So that looks pretty attractive, assuming we see the stock bouncing off of support and starting to rally higher. That bounce would probably put the stock at around 374. So that gives us our $1 level between the stock's current price and first level support. Now, from there, if we think about the next opportunity, if the stock can push above 385, there's upside to about $400. That means from the stock's current price, there's about $27 of reward against the next level of resistance at 345. If the stock drops below 373, it's probably going to find that next support level somewhere in the $345 to $350 level. That means that we've got about $23 of downside at the minimum for this stock. So 27 to 23. The very near-term setup looks very, very attractive. On the intermediate basis, however, maybe not so much, because our reward to risk is not anywhere near the minimum of 2 to 1 that we would usually be looking for. Now, if you're willing to consider all of this current price action in a much longer term perspective and think about giving the stock an opportunity to follow its much longer trend, we can, of course, point back to the 200-day moving average, which is trending upward very, very nicely. If the stock can bounce off of this current line and move higher, then all indications should be that it has an opportunity to extend the long-term trend even further. If that's the case, then our value proposition starts to come back into play, and we can start to think about it on a much longer-term basis. And when you think about all of those things all together, it becomes a lot easier to think about the reality that with its combination of fundamental strength, value proposition, and overall price action right now, Netflix really does look like a screaming buy. Hope this is useful. If you like this video, please go ahead and subscribe to my channel. You can also check out this video for some more information about the way that my Rebel income system works. If you would like to receive my trading alerts for each trade I place in the Rebel income system, you can subscribe using the link in the description. Thanks again. Talk to you again soon.